Okay, so today's the first session of the state of things, and we're going to be talking about housing rates, and we're also going to be talking about the predictions for the dollar, US 30, stuff like that. Okay, so first things first, what's going on in the American market? Now, a lot of people here are from India, and that's perfectly fine. What you should know is that if you study American markets, you will end up seeing a lot of how Indian markets may be affected. Now, is that absolutely perfect? Like, oh, I see with perfect accuracy where the Indian market's going to go? Obviously not, right? But it is going to have something that will essentially push in a certain direction, right? So generally, if you see how the Indian economy, because it's very reliant on production, one, and also export, you guys should realize that the Indian market will be affected by a decrease of exports, or a decrease of exports from in India, and a decrease in imports in other countries. Now, here's the thing, right? So with how America works, it's a little kind of contradictory because there's something known as the CPI, okay? And does anybody know what the CPI actually stands for? Does anybody know what
Consumer
CPI?
Consumer Price Index.
Right, consumer price index, right? That's pretty simple. So I'm also going to give you guys some things that you guys can essentially use in your own, like on your own time. Okay, so CPI means consumer price index. Okay, now there's something called market basket, which you don't essentially need to know right now, but basically, right? Basically, what this means is the consumer price index. A lot of people look at this and like, oh, well, I know what the consumer price index is. Okay, you know what it means, but what does it actually like refer to? Well, essentially what it refers to is the average price of consumer goods or services. Okay, so essentially this means the price or the pricing of average goods in a household. So for example, actually, so market basket, so let's look at some examples for market basket products. So each one, so this doesn't mean like how much does lumber cost or anything like that, right? How much does an industrial material cost? What this is factoring in is what every person has in their house. So for example, groceries, toiletries, other things like that. That's essentially what this is pricing in. So essentially the price of food, the price of things that we consume as average people, okay, or services. And services can include a big variety of things. Now, everybody understands that. So there's a direct correlation between how CPI reacts and also how inflation reacts. And I'll explain that in just a moment. So so essentially what CPI is telling you is if the average price of consumer goods and services, if they are rising, what does that tell us about literally everything else in the economy? What does that tell us about literally everything else? So if prices are rising, what does that tell us? And so somebody said recession ahead. Okay, so if the consumer price index itself rises, it doesn't necessarily mean that there's an inflation coming up, or rather, what's it called? Recession ahead. It doesn't necessarily mean that there's a recession in front of you. What this means is that the majority of people will have to spend a larger amount of money on basic necessities. So essentially, people will have to spend a lot more on groceries. So in the US, and I live in North Carolina, so this is all from the perspective of North Carolina. So that being said, if we kind of, so I'm going to put all of this from the perspective of North Carolina, for example, right? So right now, if we're looking at this, last year-ish or like 2 years ago, I would have had to spend about, let's say like $100 worth of groceries would get me about a week and a half, almost 2 weeks of food. Actually, more like, you know, yeah, like around 120-ish, right? Would get me about 2 weeks of food. So essentially, that means that now, if I go to like Harris Teeter or wherever I want to go buy groceries, I have to spend almost $200 for the same stuff. And again, this is not a number perfect estimate, okay? This is simply how I have perceived the increase in consumer price index. Okay, this is simply how I have looked at it. So if I have had to spend a lot more money on groceries for the same amount of food, or for at least the same amount of time that I'm going to be eating for, this essentially means that I'm going to have a lot less money to be spending on other things. So for example, I'm not going to be able to spend on the entertainment industry. So I'm not going to be able to buy, you know, a HBO subscription or a Disney Plus subscription, or I won't be able to go to the movies that often, or I won't be able to, you know, buy a new game or a new car, stuff like that, right? Because my preoccupation is going to be getting food in my body, right? That's going to be my main focus, not, you know, buying a new car or anything like that. So with that being said, do you guys see how the increase of consumer price index affects normal people? Basically, they have a lot less money in their pockets afterward. Now, I do not believe gas fits into the consumer price index. However, gas is a specialty product. Now, what does that mean? Essentially, what that means is that gas is something that needs to, it's not something that we can just grow ourselves, right? I can't grow gas in my backyard. So I have to rely on a big oil provider to actually give it to the gas station that I go to, and then that I have to purchase from the gas station to actually fill up my car. So what this means is the increase of consumer price index will also mean that I will have a little bit less in my budget to actually spend on other things. That includes gas. So essentially, there's something called what I call a budget of necessities, right? So, oh, that's not how you spell that. I can't spell. Hold on, let me type it over here. Okay, cool. Okay, budget of necessities. So essentially, what is a budget of necessities? Well, what this means, what a budget of necessities is essentially you have a certain amount of money stored away for your bills, for your food, for your gas or transportation costs, right? And other things like that. So if you kind of keep that in mind, you will end up realizing, right, that this budget ends up increasing, right? This budget of necessities ends up increasing while the consumer price index also increases. Because if, actually, let me see if I can pull up a graph of the consumer price index. Oh, that's the surplus. Whoops. Ah, I think there is one. Yep, here we go. Nice. Let's pull this up right now. Here we go. Does everybody see my screen?
Yes, sir.
Cool. All right, so if everybody sees my screen, do you guys see exactly what I'm looking at here? And the reason why I'm showing you guys exactly what I'm looking at is because I have put a lot of stuff on my story on Instagram. And I have also set a lot of warnings in the Empire IX channel for you guys to start stocking up on foods, for you guys to start stocking up on non-perishables and stuff like that. And the reason why I want you guys to start doing that and taking care of yourselves is because look at exactly what the consumer price index is doing. So this is a graph of the consumer price index from 2002 all the way up to May 2022, okay? Now, this is directly sourced from the US Bureau of Labor Statistics. You'll see a note down here that the shaded area represents recession, right? Determined by the National Bureau of Economic Research. Now, a lot of people have been saying like, oh, well, I live in India, so this doesn't apply to me. It does apply to you because if you put a chart up next to you, you see that when the US ends up going into recession, the rest of the world also, it doesn't trail as hard, but it does trail, right? So it does have a kind of a splash effect around other countries, especially big partners of import and export, okay? So these are essentially all of the items that will be included in the consumer price index. Okay, so this is all of it. Oh, okay, so gasoline is actually priced into the consumer price index. Interesting. Okay, cool. So gas is factored into the consumer price index. Okay, but if we're looking at all items, this is essentially an average of all of the items here, right? That's essentially why it's the consumer price index. Like I said in the definition that I put on the trading view chart, it's the average price of consumer goods and services. So all of this stuff is considered consumer price, basically stuff that we need: electricity, shelter, apparel, that's clothes, right? Medical care, commodities. So any procedures that you guys have done to help your health. So for example, my grandmother had to get a couple heart tests done, and since she's on charity, that's a little bit, you know, that could have, the price could have risen without insurance. So essentially what's going on right here, I want you guys to focus on this, and I want you guys to focus on this. Remember that us as traders, we end up seeing how price reacts to certain effects, right? What we want to do is we look at patterns. We don't look at patterns like the double top, the double bottom, but what we do look at is we look at how price has reacted in a certain area. So for example, if I were to turn this into candlesticks, what would you guys see here? A lot of people would have ended up seeing a pattern, right? In these cases, you guys would have seen that during an area of recession, right? During an area of recession, you guys see small peaks, right? We go above equal highs or above recent highs. You guys see this right here, right? We go above recent highs, and then from there, we drop. Now, what causes this drop? What causes this drop is something that is a little bit more deeply ingrained into the theory of economic recession. But it's essentially that prices are forced to drop because of the amount of money that people have to actually spend. So remember that I told you guys that we have a certain budget that we need to keep every month, right? To put our bills, which include shelter, right? To include school, to include, and some people actually during times of recession have to drop out of school because they can't keep up with the payments, right? Shelter, so, you know, rent, stuff like that. All of this kind of stuff, we need to make sure that we keep at least the necessities in line. So the necessities are the ones that we have to keep our budget for. If we don't have enough money for the rest of them, you know, that's kind of secondary. You know, you can take a bus if you can't afford gas, or, you know, you can essentially, you know, not buy new clothes that month, and you'll cut back a little bit more. But prices are forced to drop on the majority of recession times because of the fact that people can't actually spend on them. So a lot of these big companies, they end up, what they charge is something called a markup. So essentially their provider to actually make the product is something called a production cost or an overhead cost. Okay, and let's actually go back to the trading view chart, and I will draw this out for you guys. Okay, so let's kind of go up here and let's talk about how products are actually made. So if we talk about it like this, right, we can kind of talk about it this way. Products have something called overhead or production costs. Well, both of these are kind of similar, not similar rather, but they're tightly put together, right? So product cost, so or production cost. Okay, so essentially what production cost is how much it actually costs the company to make the product that they're selling. So if, for example, I am a what example could I put here? Let's put it this way. Let's say I am a producer or a manufacturer of soft drinks, right? Let's say that I make a soft drink. Think about it this way. Let's put your favorite soda. So you guys could just put your favorite soda in the chat. I'll put my favorites, my favorite drink, right? So my favorite drink, funny enough, I'm still a child. I love Snapple. Okay, I love Snapple. It's the best drink who ever graced this earth, and it is God's gift to humanity. So in my opinion, right, I really like Snapple. How much do you guys think Snapple actually spends making the drink that they sell? Let's actually look this up. Let me see. Let me see. I'm still looking. 1 second. So, okay, yeah. Actually, we don't know about Snapple. Let's change it to Coke. The production, what's the production cost of Coke? I love Snapple because it tastes amazing. Strong taste. That's why it's awesome. It's full of sugar, but it's amazing. Let me see. Okay, so essentially the production estimate is the material of a 1 liter soft drink bottle is about 10-ish cents. So it's about 10 to 15 cents. Let's see, 1 second. So yeah. So for about, let's put Coke, right? So it's about 30 cents for 1 20-ounce bottle. Okay. Dilip, this is a series that is for everybody. It's essentially going to be talking about the macroeconomic factors of the world and also predictions for the upcoming week in terms of charts. So after I'm done with this little lesson, I'm going to look at the other charts, and I'm going to be looking at essentially what I want price to do. The beginner beatdown series are essentially like where I start from the absolute beginning, and I start and I start teaching, you know, the new stuff is on Thursday. That's the beginner beatdown. So everybody that's a beginner can come to that class. On Friday is the advanced classes, okay, or the continuation of beginner beatdown, depending on how we do it. Yeah, no problem. Okay, so essentially, you know that Coke has a production cost of about 30 cents for each 20-ounce bottle. Now, how much is 1 20-ounce bottle? So 120-ounce bottle on average costs $1.90. Okay. So this means we'll talk we'll look at it this way, right? If the production cost of Coke, and we're just looking at products, we're not looking at anything else, right? We're not looking at anything else. What we're looking at here is essentially that Coke spends 30 cents to make the bottle, to make the syrup, to make the ingredients, to actually put it out there, to actually produce one bottle of Coke. That doesn't include shipping, doesn't include anything else, okay? It just includes this. All right, so if it's 30 cents, let's do the math on this. So essentially, their profit before production costs, or rather manufacturing costs. Geez, not manufacturing costs. Costs actually like shipping costs and stuff like that. Overhead. That is going to be the not net. It's going to be what's it called? One second. Yeah. Okay. So this is before deducting the actual cost of shipping and stuff like that. Okay. So this is just the overall profit that they make from just manufacturing and selling it. Okay. So essentially, they make 30 cents, and let's actually like flip this over. It should be flipped over, but you guys get it, right? Absolute value. Cool. Okay. So essentially, you get $1.60. So this $1.60 is what they end up keeping, right? Now that will go to that will go to shipping costs, that will go to maintenance costs, that will go to everything else, right? So that this isn't the actual gross profit, but this is essentially the cost of goods sold, right? So this is where I was going with this. If the production cost stays about the same, right, this price will remain about the same. However, if a lot of so where Coke gets their ingredients is their providers, right? So if they get their providers from somewhere else, like for example, in Mexico, I know this from actually going over there. In Mexico, they actually have to get sugarcane sugar. That's why Mexican Coke tastes different than American Coke, because they actually use sugarcane sugar. So if they have to produce, for example, if they have to get from their producers a certain ingredient, and the price of that ingredient increases because of the amount of basically economic recession that's going on, Coke will have to raise their prices slightly for their bottles. You see this in a lot of different companies. Now, I'm using Coke as an overarching example. Obviously, their practices are a lot different. Other producers will do things a lot differently. So, for example, one big example of this is Arizona iced tea, right? Before they were 99 cents, and now they're about $1.30. Why? Because they had to increase their prices due to the fact that their production cost went up. So if their production cost goes up, right? If their production cost goes up, then that means that their prices also have to increase, right? Their prices also have to increase. And that means that us as people will have less to spend on other things if we need this product. So another big example of this is grooming. Like for example, like personal care and grooming things. So for example, let's put an example that I was actually thinking about the other day. Deodorant, right? Deodorant used to cost about $4 or $5, right? And now it's up to $8. Right, so personal grooming kits and personal grooming appliances are actually increasing, or products, right? They're increasing quite a bit, and because of that, I may. So us as consumers will have to buy those things because they're necessities, right? You obviously can't go without those things, but that also means that you will have a little less to spend on other things that you might want. For example, you may not be able to go eat out as much, or you may still want to, right? And you're going to have to rack up credit card debt, right? So stuff like that is essentially how all of this trickles down, right? So if the consumer price index goes up, that essentially gives you a kind of look into certain things that are increasing. And we saw on that list essentially all of those things, right? We saw energy at home, electricity, apparel, medical commodities, shelter, rent, stuff like that. And some of these different things are actually considered commodities, but they are they're still included in the CPI. Okay, 1 second. Okay, sorry, I just had to take a sip of water. All right. So let's think about something else that I actually just mentioned. So I just mentioned racking up credit card debt. Oh, by the way, are there any questions so far? Cool. So what I wanted to talk about next is also something that a lot of people have been texting me about on Instagram, is essentially credit card debt and interest rates. So interest rates, when spoken about in the economic sense, they're a little bit different.
Sir, I
Yeah,
have a little question.
yeah. Uh-huh.
You told that basic necessities sometimes basic what I could say raw material of
Hmm.
production. If their why their cost is increases because of supply and demand
So essentially,
or
supply and demand has a lot to do with how. Well, yes, kind of. So essentially, if the price of a supply, so demand will essentially be static, right? So demand, people will need things that are necessities no matter what. So no matter what happens on this earth, you will need food, right? You will need water. You will need basic hygienic things, right? No matter what happens in this world, you will need those things. So demand will remain static because people won't suddenly not need food, right? So if that happens, but the price of production for let's say for example farmers, right? Let's say in terms of food, let's go into the agriculture side of things a little bit more. So let's think about it this way. Let's say a farm or a farmer that produces let's say beef, right? So they take care of cows. Cows are an animal that is not essential, that's not really cheap to take care of, right? It may be cheaper than other animals, but it still needs a lot of costs towards, their shelter, towards their food, towards rearing them, right? Towards paying people to actually take care of them and breed them and make sure veterinarian costs, right? Making sure that they're healthy, stuff like that. So those are all overhead costs. Now, if all of a sudden, right, prices for the feed of these animals goes up, unfortunately, farmers are going to be forced to raise their prices because of markup, right? So what I was talking about earlier is that this is essentially the production cost of what they have, and the difference between these two is something called markup. So that's actually where I was going. I forgot about that, right? Markup. So essentially, markup is something that a lot of people are very against, but it's something that is kind of needed in terms of business. Now, excessive markup is also dumb as hell because that happens in the medical industry, where a big pharma, for example, right? They charge something that costs them $5 to make, and they charge you $900 because they're just greedy, right? They just want more money. So, for example, a lot of cancer drugs they charge you $900, even though it costs them like $40 to make, right? So it will, that's essentially a markup. So it's an increase in, it's an increase from selling price to production cost. So let's put it this way, actually. Okay, so the markup percentage is determined this way, okay? So let's put it markup percentage, MP equals selling price per unit minus cost price, again, per unit, everything is per unit, okay? And let's put it like this. And then we will do a small little line here because it's over. Oh, whoops. Divided by cost price per unit. And again, since it's percentage, this is MP is markup percentage. Let's put it this way, right here, right? Since this is a percentage, it will always be times 100 to actually make it a percentage. So essentially what this equation is telling you is the percentage of actual markup that that a certain company will mark it up to actually cover certain other costs. So if there is, the selling price per unit is $1.90 minus the cost price per unit, which is 30 cents, divided by the cost price per unit, which is again 30 cents times 100, you will see that, Coke has quite a bit of a market percentage. But actually that it's quite a huge market percentage, but you guys end up seeing, right, and we'll come back to interest rates probably next week, but you guys end up seeing that when these markups are forced to rise because of the so let's kind of simplify a little bit here. Let's think about it this way. All of these will have a direct correlation to the markup rate. So the markup rate is essentially your selling price. So let's put it this way. Let's say that the selling price per unit increases. Okay, if the price increases, right? If the price increases, that also means there are two reasons why a selling price will increase. One, a selling price will increase because the company just wants more profit, right? And that may reduce actual units sold, or it might not, depending on the actual product, right? But generally, if the selling price of a unit that's already been established, right? That's already a mature product. The only reason they would raise their prices and risk losing people that buy their product is because their cost price per unit has also increased, right? So like I was saying about cow farmers, right? If for some reason the feed goes up or the cost of lumber to actually make their habitats, increases, they will be forced to mark up their beef or mark up their product by a considerable amount. And that will mean that essentially the people that buy it from them have one of two options. They can either continue buying for them at the higher cost, right? But if they buy from these people, right? If they buy from the cow farmers at a increased cost, what does that mean? That essentially means that their prices will also have to increase. Do you guys see how the raising prices of a certain product can lead to a whole trickle down of a bunch of stuff, right? So if they want to buy from these farmers, they will have to buy at the higher rate, or they will have to go find another producer. And the majority of the time, if it affects one producer, most of the time it'll affect more than one. It'll affect 2, 3, 4, right? Or the majority, all of them, right? So that means that people, for example, like restaurants like Texas Roadhouse or Applebee's or other things like that sell a lot of beef, or butcher's market, stuff like that. When they sell a lot of these a lot of these beef products, they will also have to increase their prices. Why? Because they also have to meet their market percentage, because they have something called overhead costs, which is essential, or overhead and production costs, right? The same exact costs of production that it takes to actually make certain things, producers and sellers, right, retailers will also have to incur those costs. So if the prices of beef farmers goes up, that means that a lot of restaurants, their prices also have to increase. And a lot of times they'll tell well, at least if you guys live in the US, do you guys see a lot of restaurants or a lot of seafood places specifically? This is a very good example. Seafood places, they will tell you, they'll put a little sign up front, and they will say, due to the increasing prices of, I have actually seen this example many times, lobster has increased quite a bit, right? Lobster prices have increased. Or they will say, due to the raising prices of X, Y, and Z, we have raised our prices. We hope you guys can understand, right? I've seen this also in a lot of breakfast places. So for example, here there's well, at least in North Carolina, there's a popular small chain called Braves, right? And some of their places have had to shut down because of the raising prices, but the ones that are still remain, those essentially say, due to the increased prices, we will have to raise our prices starting a certain day, and they will have to raise their prices. So that means that if they raise their prices, that also means that we as consumers can't actually buy those things very often. So people will have to start reducing their prices. They will try to go as far as they possibly can, but then something has to give, right? You could either stay in this method of stagflation, but the Fed or something has to give. And a lot of the times what has to give is interest rates. Okay, and that's something that we will talk about next week in terms of interest rates. Okay, so interest rates. Now, just to give you guys a little teaser before next week. Well, we could keep going, but we might wait until next week. Okay, so essentially what interest rates end up doing, right? It's essentially the definition of interest rates by the economic textbooks that I have learned from. Okay, it's essentially a whoops, typing here. It is a amount of premium charged on top of the of a loaned amount to a borrower for the use of money / assets. Okay, so this is essentially what interest rates are. Okay, so it's a premium charged on top of a loan or borrower for the use of money / assets. And during a time of recession, or at least before a time of recession, a lot of these interest rates will skyrocket. And what do we see now? We see that interest rates are skyrocketing. Now, what do I mean by how interest rates affect everybody? Well, interest rates affect everybody because almost everybody has a credit card, but more importantly, almost everybody has a loan, right? Almost everybody has a loan for certain things, right? It can be a home loan, though mortgages use simple interest, so that's a little different. But still, what ends up happening is people will have to pay more for the loans that they've taken out. Okay, and that can include a variety of different loans that people have taken out, whether that be just loans that they've taken from a bank to actually pay for school or for food because they just need money, or anything like that, right? They will have to charge, so banks will have to charge a higher premium to actually give out those loans, right? And those interest rates can lead to a lot of different things, but we will talk about that next week. Okay, so to close out this class, I'm going to look at the major pairs and I will analyze exactly what's going on in them. And yeah, so does anybody need to take a screenshot of these, or does anybody want to take a picture, anything like that? I will leave this up for the next about 30 seconds, and you guys can take your screenshots and talk. Or sorry, yeah. And if you guys have any questions, you guys can also talk about them right now. Does anybody have any questions?
Sir, we are learning more about interest rate in next week.
Yes, yes, you are. You're learning everything about interest rates next week. Yeah. So if CPI increases, then currency pair will increase. So not exactly. So the correlation between CPI and, like, for example, the dollar index, it hasn't been proven. What I will tell you though is that if the consumer price index shoots, a lot of people will get confused. And I saw this post on Reddit earlier this week. Somebody was having a lot of trouble, and they were saying, like, why is the dollar bullish if it's so weak? Okay. The Dixie, or the dollar currency index, right, is essentially how a lot of people determine whether how strong or weak a certain currency is. By all means, and by if you ask like 9 out of 10 people, they will tell you that this is exactly what the dollar index is. To me, the dollar index is simply another bellwether type thing. So if, for example, if the dollar keeps rising and I expect price to do a certain thing, I can go to euro and I can go to GBP, and they will be generally doing a similar thing. So, or they will actually be lagging behind it. So if the dollar is doing something specific and I look at the euro and it hasn't done that yet, I can essentially expect the euro to do something like that. So to me, the dollar index is not essentially a correlated thing towards the CPI. It's just completely on its different spectrum. But we could definitely take a look at it and check. Though there isn't an existing like graph like every like 15 minutes or everything like that in terms of the CPI index, because the CPI index is something that is taken monthly. So it's not something that's taken every 15 minutes. Okay, does that make sense?
Yes, sir.
Cool. So next week we're going to be talking about interest rates as well. So that'll be something that doesn't really affect that it affects the market more. Interest rates does affect the market a little bit more. Now, don't get this confused by me saying that fundamental analysis is better than technical. Okay, to me, technical will always be the literal like the best type of trading. Okay, it will be the best. To me, it is the thing that I understand the most. And I'm only doing this class because a lot of people have been asking me economic questions, and I'd like to teach you guys some things about economics, but I can't do that without like a degree, unless like if I want to teach at a university or other places like that. So I want to teach you guys what I know, essentially from what I know, from what I've learned. Okay, so now we're going to look at the dollar. We're going to look at everything like that. Okay, so last week we spoke about how the dollar was probably going to keep dropping, and to me that still hasn't changed, but I'd like to be flexible. Reason being, yesterday was Monday, but yesterday was also a bank holiday, right? So yesterday the US banks were closed. So if yesterday banks were closed, that tells me that at least in this case, right, that tells me that I do not want to be trading on Monday. What does that tell me about Tuesday? Well, that tells me that Tuesday, might be choppy, right? It may not be favorable. Why may it not be favorable? Because what do we know about bank holidays? So this was here, this was Monday, right? What do we know about bank holidays, guys? From everything that I've taught you, what do we know about bank holidays?
At bank holiday, IPD algorithm is off.
Right. So not essentially off, but it's a little more, the volatility is too much for us to get a perfect entry. Remember that we're precise. We don't want half-assed entries, excuse my language, but we don't want, we don't want halfway entries. We want entries that are, that are high quality. So essentially that is why you wait, right? And what ends up happening on Tuesday sometimes is volatility may continue through that day. And like you see here through New York, so you guys see New York and you guys see London close, you guys see that price essentially didn't quite, take, it didn't have as much good volatility as we would have wanted. So because of that, we essentially don't want to be trading during those times. Okay. Does that make sense?
Yes, sir.
Okay. So since we know that, right, since we understand that, we will also realize, right, that price around this time may be acting a little wonky. What did we see during New York? We saw consolidation. What did we see during London? Sharp rise, right? Just a straight up buy from everything, right? Cool. Now at the end of London close, we're seeing that price is just plummeting, right? Back to midnight open. Now, is this a place where we want to be participating in the market? I would not, right? I would not participate in this market. And that's simply because I wouldn't want to participate, right? I don't really want to participate. I don't really want to be a part of this. So because of that, I'm just not going to participate in this kind of market. Oh, right. Right. It's a different indicator. Oh no, I have to change it. All right. But everybody understands essentially what I'm talking about, right? So what you want to do now, and the reason why I haven't sent out trades today, is because of the simple fact that I don't want to I don't want to be taking trades while the algorithm is still rebalancing. So what am I going to do? Tomorrow, I'm probably going to be looking for some trades, right? But today, I'd rather not. I'd rather not look for trades. I'd rather not look for anything like that until the algorithm has actually, rebalanced and done what it's wanted to do. But I still would like to see something radical from the dollar index. And if you look on the 15-minute on the dollar index, you may see something a little similar to what Euro USD is doing, though on the opposite side, right? If you guys look at this, do you guys see this? Do you guys see how basically it's flipped, right? You guys see how it went down, then back up, consolidated, and now it's shooting up. Now let's look at Euro. It went down, went up, right? Came back down, consolidating, now it's going down, right? So what I would like to do is I would like to see. So first, we need to mark off our new liquidity points, right? So we have this as liquidity, minor liquidity. We have this as major liquidity, which may come into play later. We have this point right here that I don't know why it's there. Why are you here?
Sir, Garrison, sir, I think gave us a trade at afternoon.
Oh, I'm not sure. I didn't see it. Go ahead.
So some of people's in our group took that trade. So they're asking that what should we do? Do we close or do we like what we can do on that trade?
Is it open? I don't know. I didn't see him send a trade. I didn't check.
Okay, okay, sir. Sir, could you please check because of many of people's in our group took the trade.
Sure. Well, the thing is, like, Garrison's analysis may be different from mine, so I'm not sure. Hold on. Entry price 1.05321. Oh, he took it from here. Interesting. Two six. Okay, so I kind of see what he's talking about. So essentially what he's trying to do is he's trying to play from this entry right here. Well, not this entry technically. It's more of playing the exhaustion of the pair. So if price drops down here, right, price will essentially try to rebalance as much as it can, and then it will try to fire as much as it can afterward because it's going to try to rebalance. Again, it's up to you guys whether you want to take this trade or not. I personally would not take it just because of the fact that it's Tuesday and you're rebalancing, right? The algorithm's still rebalancing. However, if you would like to hold it, if your analysis matches up with it, you absolutely can. I am not, because I don't want to take trades today because of the simple fact that it's Tuesday and the algorithm is rebalancing. However,
Thank you, sir.
I actually, yeah. So I wouldn't be interested in buying right here. But I would like to see price clear these highs at some point. I would like to see price clear these highs. So I think the sentiment is correct, but we're out of session, right? We're out of London close. So that's something that I'm gonna be like, I wouldn't be too keen about it, but it definitely could work. So yeah, so I will look at US 100 in just a moment. Okay, so on the daily, we have a couple fair value gaps, which I would like to exploit if possible. We have some fair value gaps, and we just swept liquidity. So what I would expect is I would expect bullish NASDAQ to come up and fill as much of this liquidity void as possible. So my target would be up till this top line up here. This would be my target, filling in this fair value gap. So I would be looking for buys these next few days. And yeah, so let me see that. Let's go to the hour and let's see what's rocking up here. On the hour, we see that we also do have a bit of a fair value gap in between these places right here. So we could possibly see a bit of a rebalance either tonight or tomorrow. And then we could end the rest of the week bullish, trying to clean up these highs. So my short-term target of the week would probably be these highs right here. Okay, that would be my target. However, we do have some trendline liquidity and some low side liquidity down here. Okay, which would be something that would come into play possibly once we reach our buy side target. But I would like to see the sell side target, the buy side target get met first before the sell side targets get hit. And that makes sense. All right. So that's essentially what I would be looking for. And that also translates to ESM, or what's it called, to SPX. And yeah, guys, if you guys are in the Euro USD trade, it's 1%, it's early in the week, hold it, just risk it. If you guys want, I think you guys could hold some pretty nice profit here. So just don't be afraid of losing, guys. Remember that your risk management is going to be your shield. Remember that your risk management is going to be what protects you from losing a lot of money. So just hold it, if you want, and then from there, the rest of the week we can probably we can very likely make it back if it does lose. Gold, majority of you guys know I don't trade gold. I don't trade gold for the simple reason I look at it very inconsistently because of the fact that gold is a speculative market, okay? Meaning that it can and absolutely will do whatever it wants, okay? It's a lot more influenced by speculative fronts rather than pairs, right? So I just don't trade those. Germany 30, another pair I don't really trade, but I'll take a look at it. I don't look at it because it just, it's not interesting to me, at least to me. Let's see what's going on here. So do you guys remember that last week I told you, well, not last week, but a couple of weeks ago, I told you guys that Germany 30 would likely keep dropping because of the fact that it was continuing to return towards, it was continuing to crack down on sell side liquidity. That's exactly what it did, right? Sell side liquidity got cracked. There's a weekly gap right here that could be considered a fair value gap. Price may want to rebalance off at this point, but there is a major point of liquidity down here. So I would be wary of this right now, of this right here. And I will want to essentially want price to rebalance. So there are two things that I would kind of keep in mind right now. It would be this level right here, right? And this level down here. Actually, this level too. But this is a little bit different. Yeah, that level right there. Okay. And then these up here will essentially be the ones the rebalancing points that you guys want to kind of keep an eye out. So if let's look at the hour. Let's see what's actually going on. So we do see some displacement. I would like price to break through this level. Now if price breaks through this level, did we actually meet this? We did. So price actually did meet the void up here, right? So if price does displace through this level, I would search for an entry up here. Okay, that's essentially what I would be doing. If price does displace, like meaning it falls through this level and then returns, yeah, I'd absolutely be looking for that. Actually, you know what? I'm gonna add an alert. But it's only if it displaces through this level. If not, then no. Okay, yeah, that's essentially what I would be looking for. And again, that's on the hour, so it may be a little bit more wonky. On the 15, you may see it a little bit better. Yeah, so I wanted to displace through here, boom, and then come up. Okay. WTI, I don't particularly trade WTI, but I'll take a look at it because I'm trading futures. Let's look at the daily. Okay, so you barely missed a high, which is annoying. I always hate these situations. They're just they're not uncomfortable, they're just annoying. We have some sell-side liquidity here. We have another point here. We have another point down here. So we have some very specific points of liquidity. Right, you have a lot of liquidity in these cases. So at this point, I would be looking to rebalance sell-side liquidity. Another note, this is not an order block. Okay? That is not what people would consider an order block. At least not like the up-down candle sense. Okay. Now, I think at this point, let's actually look at the hour chart. This is what I mean by it's uncomfortable, because my instinct is saying rebalance this liquidity void, right? Because this is a liquidity void. So I would like to rebalance it, right? I'd like to fill it as much as possible. However, you're stuck in literally a range. Like you literally cannot move from this point. So if you can't move from this point, that means that you are stuck in a range and you need to wait for either external liquidity to be broken. Okay. Right now, I would wait for either an external liquidity point to get broken, or you can play the macro inside the micro. Sorry, not macro. You can play the micro inside the 15-minute chart or the 5-minute chart, where you guys can play the macro inside here. But I would also realize that there are 2 points of external liquidity on either side, and you might want to use your PD array for this, right? You may want to use your arrays to actually hold an entry to actually clear one of these two. But if you go higher, right, if price decides to go higher off of this range, then I would rebalance as much of this as possible, probably up to here. Okay. And if price decides to go lower, you have major points of liquidity down here. So that's what I would go for. All right. So that's my analysis for the WTI. Cool. All right, guys. So with that, I think that is good for today. On EU, on dollar index, on GBP USD, I'm going to be waiting until tomorrow to actually put in a bet on a certain horse. So I will be looking for those. All right. So with that being said, thank you guys for coming. I appreciate you guys for being here. I will put up this recording as soon as I possibly can up in the back office. I'll send it to Zay immediately after. And I hope you guys had a good time. I will talk to you guys on Thursday for beginner beatdown. So if anybody in your team is new, then that's absolutely the time to come in here and start learning the basics. All right. If you guys are a part of a big team, like for example, Mark Shepard's team, or if you guys are a part of ACE, right, and you guys have new people, that are coming in, please make them join the Empire IX channel. If you guys are not in the Empire IX channel, please send in there. You guys would be supporting the channel massively. If you guys are leaders and you guys are just copying and sending the link to your groups, please, I encourage you to watch Zay's video on how to let people join the actual channel and let them join the channel. That helps us as presenters, as teachers. That is literally how we get paid. So I will appreciate you guys if you guys will send out our channel link to all of your IX subscribed ProPack students. All right. So with that said, thank you guys for being here. I appreciate it and take care.